Today, I'm going to tell you about 5 of my personal favorite Canadian stocks to buy right now in March of 2025. All of these are great Canadian companies that present a fantastic opportunity to you as an investor. All of these are companies that I either own, so small personal position, or I own in the public portfolio. So disclaimer right up front, definitely biased towards these stocks, but that's for a good reason. And let me explain to you by starting with our first company today, and that's National Bank. National Bank of Canada is one of those companies that I think is a really fantastic option. It's in that big 6 group of banks, the new kid on the block, but thanks to that, they have a nice low PE compared to a lot of their peers, and they've been growing incredibly fast. A couple of things that really stand out to me talking about National Bank: their target audience. It's been a Quebec-based bank for a long time. They've seen a lot of growth in that area, but with the CWB acquisition, now they're also expanding a lot in Alberta, in British Columbia. I think they have a lot of exposure to parts of Canada that are growing fast, that have some really strong, resilient industries, and they've been able to capture growth while avoiding some of the traps that have been the sort of Toronto mortgage market, specifically the condo market, as well as some of the Vancouver mortgage market, right? They've dodged a little bit of that. Their loan book looks okay. Obviously, everybody's loan book's a little shaky right now with all of the sort of drama in the Canadian economy, but that means valuation isn't crazy. The PE ratio looks great, and they're just growing great. I mean, look at the compounds here. 5-year compound growth rate of 9% for a bank is pretty great. EPS compound growth rate almost 11%. Dividend, right? We're seeing a payout ratio of 40, a yield of almost 4%. It's growing. Again, that 5-year compound rate's about 10 a year. All of that looks pretty great. FinChat has their price target 133 next year, is sitting at 120 for a bank stock. Getting a good amount of price valuation of that share price appreciation is really great. But obviously, you're investing for the long run. You're investing for a dividend. These guys are a great option. The amount of runway they have compared to their peers is huge just because of their size. So I think it's a really solid pick that makes sense in my portfolio and probably makes sense in a lot of yours. The second company on the list today is Canadian Natural Resources, ticker symbol CNQ. This is the largest Canadian energy producer, and we've talked about them a lot on the channel as we focus so much on the opportunity in the Canadian resource space. Now, CNQ is definitely caught up in the tariff drama. If you look at the screen, you'll see that since about the spring of last year, their stock price has been on a fairly steady decline. But that just means you're getting a pretty fantastic product at a great price. Look at some of the valuation metrics, right? PE right now, maybe 15, right? Mid-teens, not fantastic for the industry. Not terrible, but not fantastic. However, you're looking at the next 12 months, PE's dropped down below 12. That is a fantastic price. And if you continue to see price declines as there's more and more drama, you're going to get even better pricing, which is not an opportunity you should miss. The biggest thing about these guys, in my opinion, is their exposure to the coming boom in Canadian energy. All this infrastructure coming online directly benefits this company, and the more that's built as a national priority with investment from the government, the better these guys do. And they don't have to pony up a cent because they're not the ones building the pipelines. They're simply the ones producing the vast quantity of resources at a fantastic price. They are really set up quite well. And on top of that, look at some of the growth metrics here. Even if you're saying there's not going to be any sort of boom, they've got a compound growth of 9.3 over the last 5 years. Their diluted EPS 5 years going up about 5%. That's great. And obviously dividends, 5.6% yield is fantastic. And that dividend growth rate is out of this world. 5-year, 23.3% dividend growth. Now, obviously, there's some huge growth potential, but if you're buying this and you're comfortable holding, they will pay you a great dividend with some solid share price growth over the long run. The third company on the list today is a little bit of a curveball. We're talking about Agnico Eagle Mines. Now, this company you might not think of being a good buy right now, considering how much their share price has shot up. However, I still think they have an argument to be a good value right now at their current price. And it all has to do with the massive demand for gold. Now, if you don't know, Agnico Eagle, huge gold mining company, one of the top players in Canada, and I think probably my favorite, just in the way they operate, in their successes, and obviously in the potential. If you look at some of the important numbers here, obviously right now PE is up there high 20s, right? That's up there with the tech stocks. However, next 12 months, they're looking at a much more reasonable PE. Their growth rates look fantastic. 5-year compound growth, 27%. And their diluted EPS growth 5 years of 13.7%. They've got a small dividend, but it has been going quite quickly over the last little while. But the real story is all about gold. And gold has really, really benefited from the uncertainty in the markets, making this probably the most tariff-proof stock in Canada. They simply produce a resource that is more and more in demand, and anyone will buy that resource. Anybody wants gold from these guys. And the thing is, as much as their share price has gone up, the price of gold itself has gone up far more dramatically, meaning that while, yeah, the stock is expensive, gold is much more expensive, and all of that value drops to their bottom line. Every dollar that goes up in the price of gold, this stock should go up too, and it hasn't been. And so whether that be because investors are worried or because maybe they just don't see the opportunity, I still think it makes these guys a pretty great play. Particularly if you're expecting the next couple years to see increased central bank demand for gold, maybe increased investor demand for gold, as geopolitical uncertainty pushes investors into that asset class. These guys are going to profit. My fourth stock on the list today, it's a bit of a contrarian play. It is Canadian National Railway. Now, these guys are an absolutely fantastic company, very storied company. However, they've been really caught up in the tariff drama over the last little while. And with the worries about the shrinking of the Canadian economy, about damage done to the sort of international order in North America here, where all these railways operate, companies like CNR have really suffered. Thing is, they are also uniquely exposed to some fantastic opportunities here in Canada. These guys absolutely dominate the rail business in northwestern Canada, and with an increased amount of infrastructure investment, they are perfectly positioned to take advantage. On top of that, every dollar the stock goes down, you're simply getting a better price. Warren Buffett famously said that all of his companies he expects to eventually fail, other than the railroads. These guys are just so well protected by their massive moat, their historic dominance, and of course, their geographic dominance in the Northwest. They are going to be a great investment for the long run. And to be honest, even though the numbers aren't fantastic, they still pay out a 2.5% dividend. They still are going to revenue forever, and they're going to continue to be profitable, basically no matter what happens. The best opportunity is potentially they end up being the ones who get huge boosts thanks to increased government investment in infrastructure, and this stock does shoot back up to some of its historical highs. But even if it doesn't, I am more than happy to hold this stock, reinvest dividends, and just let it ride forever, because these guys will absolutely outlast me, and this industry will outlast just about every one of us. Last stock on the list today, we're talking about another energy play. It's Cenovus Energy. Now, this company has a PE right now of 12% with a next 12-month PE of up to 15. The thing is, Cenovus has had some real challenges over the last little while. If you look at the stock price up on the screen, you're going to see their stock dropping basically since spring of last year. And that makes sense because like CNQ, these guys are a large Canadian oil sands energy producer. The thing is, unlike CNQ, there has been a little bit of drama at this company about what assets should they hold, what's up with the board of directors, are they making the right decisions, are they optimizing for what's needed right now? And that means there's huge amount of potential, even if nothing changes in this industry. If the going is just stable, there might be big efficiencies coming down the pipeline. You could see them either better monetizing their assets or selling some of them off, or building new efficiencies, or benefiting from new infrastructure. You don't know fully, but there are a lot of opportunities here. And honestly, the way these guys have been trading over the last little while, getting them right now at a 12 PE is pretty great. Growth numbers look great. Revenue compound 5-year 21% or 21%, yes, is pretty good. Diluted EPS is actually down over the last 5, but it's up huge in the last 3. So a little bit of a fluctuating story there. Dividend yield maybe not quite as high, but the growth rates have been fantastic, in part thanks to recent trends. So a lot of opportunity here. I think this is one of those companies that it's not quite a turnaround play. They're doing fine. It's just there's room for them to grow. And on top of that, they're really well positioned for the boost in Canadian natural resources, not the company, just the industry. Now, as I say those 5 companies, I do want to say really quick, obviously there's a lot of other great Canadian companies out there, and you do not need to make your entire portfolio Canadian, even if you're a Canadian investor. However, these are 5 companies that make a lot of sense for me. They might make a lot of sense for you. If you're looking to invest in Canada, if you see the same kind of secular trends playing out, those are 5 names I would at least take a look at. I'm using FinChat to show you all this. I strongly recommend you check out their site. They're not a sponsor, but they do have a fantastic product. It really does help me understand some of these companies. Really helps me break down some of this information really well. They've got great graphs. They can show you KPIs, all sorts of stuff like that. They do a great job. So I checked them out. And yeah, look into these companies. See if they fit your investing style. Never invest just because somebody else is, but do check it out. With that being said, I hope I catch you in the next video.